Guys, I'm back with another YouTube video today, and today's YouTube video is going to be some important information about day trading and what actually made me profitable, honestly. And the number one rule I recommend learning in day trading is not to trade in ranges. This one confluence honestly saved me so many times and will save you guys also so many different times. Now, I'm also going to go over obviously how to find a quality draw on liquidity, because that also goes into with ranges, and also how to get a safe entry, or what a safe entry even is. This will actually like increase your guys' win rate by a ton. It personally increased my win rate by like 25-30%. I was around break even at like 50%, 55%, and it increased my win rate all the way to like 80-85%. So first things first, what is a range? So I want you guys to know what a range is. So if you guys don't know what a range is, or a consolidation, choppy market, they're all the same term. A range is pretty much price action that is playing ping pong. That's the best way I like to describe it. Imagine price is just going like this. It's not going up. It's not going down. It's not any sort of trending price action. It's just in a box. So for example, this will be a range over here. The second it breaks above this high, that will be a breakout towards the bullish side. If it breaks below the low, that will be a breakout towards the bearish side. So that's breakout is completely different, but you just do not want to trade in a range. So for example, specifically a higher time frame range is even worse. But let's just say right here as an example, obviously this is not New York AM session, it's a Saturday, so that's why price is like this. But let's just use it as an example. Let's say New York AM session opens like this. I do not want to trade price in this range or choppy market, because realistically, where are we supposed to displace? We're not going to go anywhere. We can't even find an entry. Even if we do enter over here, we don't know if price is going to come back down and stop us out, or if it's going to go and take these highs. We don't know what it's doing because it's consolidating. We're pretty much unpredictable. We don't know where market's going to go. So you never want to trade in choppy ranging markets. So another example as a range would be, let's see, like for example, you want price action like this. This is nice bullish order flow. This is okay. It's not too big a volume, but at least it's still bearish order flow. Right here would be a ranging market though, right here. As you see, price is just doing nothing besides going up and down in the same direction, just sideways. That's what ranging market is. So now that you know what a ranging market is, now you need to find a quality draw on liquidity. So never trade in a ranging market, never trade in a consolidating market, and never trade if you don't have a strong quality draw on liquidity. So how to find draws on liquidity? Realistically, this is a big misconception. People think it's like very hard to spot liquidity. Liquidity pools is pretty much resting orders. So obviously when you take a trade, you put a stop loss or a take profit. So let's say, for example, we want to enter this trade over here. We want to enter right here. Our stop loss is going to be right here, and our take profit is going to be over here. So if we want to enter this trade right here, our stop loss is a resting order. Even though it hasn't been hit yet, it's a resting order that's either waiting to be hit, or the take profit is waiting to be hit. One or the other. There's only realistically only one way, unless you manually close the trade, which still, again, it's still a resting order. These are still resting until you close the trade. This take profit order right here is resting if price is over here and hasn't hit that yet. This stop loss order is also resting. So this is liquidity right here. Price action typically wants to take liquidity and reverse the other direction, or continue to more liquidity. So usually everyone puts their stop losses below a low or a high, and take profits at a high or some sort of strong draw on liquidity, which would be other resting pool of orders. So how you can find that is by kind of understanding how other people place their stop losses and take profits. So let me explain what that means. So for example, a swing low is a resting order. A swing high is a resting order, because people put their take profits at these highs. People put their take stop losses at these highs. People put their take profits at these lows. People put their stop losses at these lows. So these are all resting orders that are waiting to be filled. So what price does is it comes, takes out those orders, rejects lower, takes out those orders, rejects lower. Price literally moves in two ways, and it's retracements and liquidity. Price is going to take liquidity and retrace. Price is going to retrace and take liquidity. That's literally all it does. So that's the most simple way you can explain trading to someone if they don't know what anything is. Price is literally only doing those two things. And this is obviously the opposite direction. There's a bearish version. It's the same thing, just vice versa. And let me show you how to spot liquidity. So liquidity can be many different things, honestly. Like there's different examples of liquidity, but let me show you guys regular spotting liquidity, as in like highs and lows. So sessions can also be highs and lows. Let me remove that. Okay, so for example, if we're going to go into a day like, actually I'll show you guys with the Discord, we can see better. So what I notify the Discord every morning, there's a reason why I mark out these draws on liquidity. I don't just do it for fun. I mark it out because it makes logical sense for price to go there. So for example, we have this 1 hour low over here that I marked out. It's a very prominent low. Realistically, out of all these lows that price can typically go to, if price is over here right now, out of every single low, yes, we can take this one, but this is a recent low. Recent lows are not strong draws on liquidity because we just put them in. There is not enough resting orders at those. Swing traders, those people that take 3 weeks to close a trade, all these people don't have their stop losses at the 1 hour ago like candle. They have them at previous days, previous weeks, previous day low, previous day high, whatever. So for example, this is a prominent draw on liquidity. It's very pointy. It's very obvious out of the market that we probably would want to come take out this low. The next draw on liquidity, this is more of a logical thinking draw on liquidity. It's not a high or anything, but it's a 1 hour fair value gap that hasn't been tapped yet. For example, price obviously moves with retracements going to the liquidity. So there's one or the other that we could do. We can either come take out this liquidity, or we can retrace and then take out this liquidity. So retrace would honestly make the most sense because we got two bearish candles over here. Price hasn't retraced in a while. So it would make sense for price to come up, tap into this 1 hour fair value gap, or tap into this 1 hour fair value gap, reject lower, and take out these liquidities over here. This is liquidity over here. This is liquidity over here. This is liquidity over here. Now, if price rejects and invalidates this fair value gap, we could take this high over here as liquidity. We could take these highs over here as liquidity. But what I want you guys to understand is that there is different meanings to it. So let me find a good example. For example, if price is over here, marking out this liquidity is a good liquidity because number one, it's a high, and we pretty much have nowhere else that price can go. But if we were to mark out like the very, very top tick of like a leg, let me find one so I can give you guys an example. For example, right here, this is a good example. So let's say price is right here, right? Let's say market opens here, and we're marking this out as our liquidity. This is a very, very prominent draw on liquidity to the market. So this draw on liquidity could have been placed because it wants to take out other orders. So if we keep scrolling, we can see that draw on liquidity, where was that mark? 246349. So that draw on liquidity actually took out a no wick candle. So this is a draw on liquidity. And how you guys know if it's a no wick candle? If you guys hover over it and you see over here the open and the high, if the open and the high are the exact same, then that's a no wick candle. Those are also strong draws on liquidity. So there's different types of strong draw on liquidities you guys can go for, but typically it's always a high or a low. Now, if you use a fair value gap tap as a draw on liquidity, that's also one. If you use data lows, because data obviously causes a big spike in price or a big downwards in price, that obviously creates a bunch of orders or resting orders that haven't been filled yet. That could be a strong draw on liquidity, either the high or the low of it. 4 hour lows, 4 hour highs, New York session, previous day high, previous day low. There is a bunch of different draw on liquidity you guys can get. The most perfect example I guess I can give would be, where do you think price is going to go logically in the next hour? Now, just don't guess where price is going to go. If price is chopping around or it's ranging, we obviously don't know where price is going to go. But if price is perfectly trending in a perfect straight line, we're going bullish, for example, the next draw on liquidity is going to be a nice prominent high. For example, right here. Why would you not think price would come here and it would come and take, for example, this one first? If we're going to take this one, if we want to take this one over here, we're going to take this one. So always go to the first one, because it's very obvious that price can come take out this liquidity and reject lower. It's not guaranteed that we're going to go always to the external draw on liquidity. External draw on liquidities are way stronger compared to internal draw on liquidities. Internal is usually my break-even point. But what I want to emphasize is pretty much, where do you think price is going to go within the next hour logically? So if market was to open right here, for example, market opens right here, right? We have two options. Either price is going to come lower, which we're in a gap. So currently, never mind, we have one option. If we're not in a gap, then we have two options. But in a gap, obviously, you have no targets. Where are we supposed to target in the gap? We have no wicks. We have no candles. It's just a gap. And if we're in the gap, until we don't invalidate the gap or we respect the gap, we don't know where we're going. So while in a gap, I never usually typically trade if we're in a 1 hour or a 4 hour gap. But it makes sense for price to come tap this fair value gap over here. Now, the reason it makes sense for price to come tap this fair value gap is because look how much market has been dumping. It's dumped what? Approximately almost 500 points. It makes no sense for price to keep dumping without a retrace. And then once we retrace, we obviously create more liquidity because we created a low, we created a swing low right here. Price is going to tap that fair value gap and proceed just like that and take out the liquidity. And again, vice versa, we're going to go retrace back into a different type of gap, retrace, take out, draws on liquidity. That's literally how my market works. Once you understand how market works, day trading is actually very simple. And buy side liquidity, sell side liquidity, bullish liquidity, or bearish liquidity, pretty much either lows or highs. So once you understand liquidity and how to find a strong quality draw on liquidity, and one thing I really recommend to everyone that's trying to learn draw on liquidity, I give out my free draws on liquidity every single morning in my Discord, and I try my best explaining on why there's strong draws on liquidity. What I really did that made me a profitable day trader, or at least profitable at finding strong draws on liquidity, compare yourself with mine. Now, don't compare your trades with mine, but compare draws on liquidity. So wake up 10 minutes before market open, right? Mark out what you think is a strong draw on liquidity. What highs you think are going to be touched. What fair value gaps you think market will go and touch to retrace back into a higher time frame fair value gap, and then proceed to a lower draw on liquidity or a higher draw on liquidity. And just compare yourself with the draw on liquidities I give out. Now from there, you can kind of see who's right or who's wrong. You can always text in the trading chat or the questions, be like, I marked out this draw on liquidity. Do you think this is a strong draw on liquidity? Or you can just be like, how come you marked this out and I didn't mark it out? I don't think it's a strong draw on liquidity. And I'll explain to you why I think it's a strong draw on liquidity. And you can easily learn off that because you're pretty much marking out. Once you start marking out the same draws on liquidity as me, or similar to the same draws on liquidity as me, or not even me, just in general, anyone that's profitable that marks out draws on liquidity, that will give you the biggest boost in confidence and actually trigger you to literally becoming profitable. But that's step 2. Now, step 3 would be the safe entry. So my 2 main things are strong draw on liquidity and safe entry. If you have those 2, you will literally become profitable. And obviously good market conditions, but there's always good market conditions realistically. So safe entry would be in the shortest way possible. An entry that won't get you stopped out. That's literally the only thing it is. So how, like I was saying, everyone puts their stop losses at resting orders, or stop losses are resting orders, either at a high or a low. So that's exactly what we're doing as well. Obviously, our take profit is going to be at the draw on liquidity, but our stop loss is what's very important because price could retrace, and we want to make sure that retrace won't stop us out, and then it goes to our draw on liquidity. So what I really do recommend is putting. Let me find one. Hold on. So for example, if we were to enter right here, this is a perfect type of entry because we can put our take profit. Let's say it's this, and we already have a 1-to-1. So let's say our draw on liquidity was right here, right? And we're targeting this draw on liquidity. We get a nice retracement. After that, we get some sort of displacement confirming that draw on liquidity, and we want to take that draw on liquidity. We enter over there, and our stop loss goes above that high, whether it's a high, low, whatever the case is, whether it's a bearish entry or a bullish entry, it does not matter. You put your stop loss at that high because this gives us time if market wants to. Where's that tool? If market wants to retrace, if market even does this and then rejects lower, it shouldn't do that. But if it does this, you'll still be safe because we have enough area for price to retrace and still hit our take profit. The reason why we put it at the high is because the second price passes this high, we have already made new liquidity. Now this liquidity is the new liquidity. We already set this liquidity. This is not confirmed anymore. We don't even care about that anymore. Number 1, we made new liquidity, and number 3, market structure is going to shift. The second we take a high, the full bearish order flow or idea would be discontinued. I would not want to even be in a trade. This is why I put it here. The second we take it, I don't even want to be in the trade. I just want to be out of the trade. I'll literally take the loss. But now let's show one vice versa. So if we're going to enter a long position, for example, over here, we're going to put our stop loss at this low and take profit wherever the draw on liquidity is. So let's say our draw on liquidity was right here. So the reason we put at this low, again, same exact reason. If market's going to come down and proceed past this, we're making new liquidity and we're continuing bearish order flow. We're going to either have a break of structure, market structure shift, whatever the case is, and we do not want to be in this trade anymore. We want to have a safe entry with our stop loss my God, I just realized I used the wrong tool for this. There you go. We want to have our stop loss under a low or above a high, and our take profit at the drawn liquidity. That's literally what a safe entry is. Now, if you're going to enter in the middle of a bullish candle, for example, like this. Let me find one. Okay, let's say, obviously this played out, but I'm just saying, let's just say you enter right here. What makes you think this would be a good entry for a trade? Realistically, we can easily, price can easily, very, very easily, just do this and stop you out. That's why you always want to enter after a retrace and put your stop loss above. So it would be smarter waiting for that retrace and entering off this displacement right here. This is what's smart. This is what a safe entry would be. So you would enter after that retracement, stop loss above that high that was created with that retracement. And obviously, if this retrace leg also gets invalidated with this, like let's say there's a fair value gap here, this creates an invalidated fair value gap. That's even better. That's not a confluence I really use, but it will add more conviction to my trade, and I'll be more confident in taking the trade. I'll risk heavier. But you always want to enter after a retracement. Never get, this is not a safe entry if you just enter right here. For example, if you want to enter right here, right? Let's say you enter right here. Obviously, price is going to stop you out because you're entering, you're like technically bottom blasting. Now, vice versa, whether if its price is going up, let me find an example. Okay, this is a good example right here. So if you see your drawn liquidity is over here, right? You want obviously to get an entry towards your drawn liquidity. Bro, this is pissing me off. So let's say you enter right here. Bro, I keep using the wrong tool. Let's say you want to get an entry right here, right? So you obviously enter without having any sort of idea if price retraced or not. You're just entering off straight bullish order flow and with no possible retracements. The second you see this displacing candle and you enter, you're pretty much just putting yourself in a position to get retraced on, and then price is going to go take your draw on liquidity and hit your take profit. So if you enter right here, boom, price is going to come, take you out because it was coming to retrace into this gap and proceed higher. And then obviously that's going to piss you off. You could have won the trade if you just entered the damn trade right here, like realistically. If you just entered over here, stop loss at this low, you would have still won the trade. Always wait for a retracement. It's better to miss out of a trade with full volume with no retracements and it goes straight to your take profit rather than lose a trade because you enter without a proper retracement or a safe entry. And that's literally the way you can increase your win rate. Now, if you look at every single one of my entries, it's always going to be an entry like that. Unless it's an evaluation account, that's completely different. Evaluations, I do not trade how I trade on XFA accounts. For example, retracement, displacement, enter to the displacement, stop loss at the low over here, and take profit at this draw on liquidity. Same with this one. Stop loss at this high over here. Held until this draw on liquidity, went break even the second we tapped this draw on liquidity and carried to the second draw on liquidity. Again, we had a nice retracement, then a displacement confirming that we want to take these draws on liquidity. It's all, every single one of my entries is going to be like that because that's what a safe entry is in day trading. Anyways, that's it for this video. I hope you guys learned anything or it helped you guys out. I have a complete free Discord where I give my free draws on liquidity and signals out every single morning. A trading chat, a trading glossary that will teach you every single trading term completely for free. You could join it with the Discord link in my bio or through the WAP link. I do have one-on-one mentoring as well if you guys are interested in that. Again, I'm not promoting that. If you guys want, because join my complete free Discord, I give a lot of information. People literally pay for these types of Discords. But yeah, if you do want like one-on-one help with me holding your hand to profitability with a guaranteed refund if you don't become profitable, then that's in my bio as well. Anyways, I hope you guys enjoyed this video and I'll see you guys in the next one.